Have you ever looked at a stock price? 1 second, it's $100. Then it's $100.05. Then $99.98. Then $100.12. Up, down, up again. Sometimes the price changes so quickly that it looks like someone is sitting behind a computer, randomly changing the numbers. But who is actually doing that? Who decides that a stock is worth $100 right now? And $100.10 5 seconds later? The government, the company, the stock market? Actually, none of them simply chooses the price. To understand what's really happening, let's forget about stocks for a minute. And imagine a lemonade stand. You own a little lemonade company. But instead of owning the whole company yourself, you cut the ownership into 100 tiny pieces. Each piece represents a tiny part of your company. Those pieces are called shares. If I buy one share, I now own a tiny piece of your lemonade company. That's basically what a stock is. A small piece of ownership in a company. Now imagine I want to sell my share. I say, I'll sell it for $10. But nobody wants to pay $10. Someone says, I'll give you $9. I say no. Then another person says, I'll give you $9.50. Still no. Then someone says, okay, I'll pay $10. I agree, we make the trade. And now we have something very important. A buyer and a seller agreed on a price. $10. That's basically how a stock gets its market price. There are people who want to buy and people who want to sell. And when a buyer and seller agree, a trade happens. Now let's make our lemonade company more popular. Instead of 3 people trading shares, imagine thousands. Some people want to buy, some want to sell, and they're all making different offers. One buyer says, I'll pay $10. Another says, I'll pay $10.01. Another says, I really want it. I'll pay $10.05. Meanwhile, sellers are doing the opposite. One seller wants $10.20. Another will take $10.10. And another says, I'll sell right now for $10.05. Buyer and seller meet at $10.05. Trade. Now another buyer and seller meet at $10.06. Trade. Then $10.04. Trade. Then $10.08. Trade. And this can happen again. And again. And again. Very quickly. For popular stocks, enormous numbers of shares can change hands throughout a trading day. That's why the price seems to move constantly. It's not one person changing the price, it's the result of buyers and sellers constantly making trades. But that creates another question. Why would someone suddenly be willing to pay more? Let's go back to our lemonade company. Imagine people discover that your lemonade is becoming incredibly popular. Yesterday you sold 100 cups. Today you sold 1,000. And tomorrow you plan to open 10 new lemonade stands. People start thinking, this company could make a lot more money in the future. Suddenly, more people want a piece of it. One person offers $10 for a share. Another says, I'll pay $11. Someone else says, I'll pay $12. More people want to buy than sell. So buyers begin offering higher prices to convince someone to sell them a share. The stock price rises. But now imagine something bad happens. A news report says people don't like your lemonade anymore. Sales are falling. 2 stores are closing. And the company says it expects to make less money. Now investors start thinking, maybe this company won't be as successful as I thought. Some decide to sell, but there aren't enough people willing to buy at the old price. A seller asks $12. Nobody buys, so they try $11.50. Still nobody. $11? Finally, someone buys. The price falls. So here's the simple rule. When lots of people want to buy a stock, and there aren't enough sellers at the current price, buyers may have to offer more. The price tends to go up. When lots of people want to sell, and there aren't enough buyers at the current price, sellers may have to accept less. The price tends to go down. But here's where things become really interesting. People don't only buy stocks because of what a company is doing today. They buy based on what they think will happen tomorrow. Imagine our lemonade company makes $1 million this year. That's good. But investors expected it to make $2 million. They may be disappointed. The company made money, but the stock price could still fall. Now imagine the company loses money. That sounds terrible. But investors expected an even bigger loss. Suddenly the results look better than expected. The stock might rise. That sounds strange until you understand one thing. The stock market is constantly trying to guess the future. Think of it like a giant guessing game. Will this company sell more phones next year? Will people buy more electric cars? Will this new medicine work? Will the company make more money? Will a competitor create something better? Will the economy grow? Will interest rates change? Millions of investors are constantly making guesses, and they don't all agree. One person looks at a company and thinks, "This is going to be huge." They buy. Another person looks at exactly the same company and thinks, "This is too expensive." They sell. Same company, same information, two completely different opinions, and that's what makes a market. Then new information arrives. Maybe a company announces amazing profits. Suddenly, people rush to buy. The price can jump. Maybe the company announces terrible sales. People rush to sell. The price can fall. Maybe a new product becomes incredibly popular. Up. Maybe the product fails. Down. Maybe the government changes a rule that affects the company. Maybe oil prices change. Maybe interest rates change. Maybe a war begins. Maybe the economy becomes stronger or weaker. All of these things can change what people believe a company might earn in the future. And when people's expectations change, their buying and selling decisions change too. But there's another reason stock prices can move so incredibly fast. Computers. Today, a huge amount of trading is electronic. Computer systems can send, change, and cancel orders extremely quickly. Some professional trading firms use algorithms that react to market information in fractions of a second. So imagine our lemonade market again. Except now, instead of a few people shouting, "I'll buy," "I'll sell." There are computers constantly placing and changing enormous numbers of orders. That's one reason prices can change faster than a human could ever keep up with. And there's one more important thing to understand. A stock price doesn't tell you exactly what a company is truly worth. It tells you the price at which buyers and sellers are currently trading its shares. Those aren't always the same thing. Imagine someone offers you $100 for your bicycle. Does that mean your bicycle is permanently worth exactly $100? No. Tomorrow, someone might offer $120. Someone else might only offer $80. The same idea applies to stocks. The market price is constantly being tested. Every buyer is basically saying, "I think this share is worth at least this much to me." And every seller is saying, "I would rather have the money than keep the share at this price." When they agree, another trade happens, and the market gets another price. So who decides the price of a stock? Not the CEO, not the government, not one giant computer, and not some mysterious person sitting inside Wall Street. Buyers and sellers do. Millions of people, investment funds, banks, institutions, and computer systems are constantly deciding, should I buy? Should I sell? How much am I willing to pay? How much am I willing to accept? And because those answers change constantly, stock prices change constantly too. So the next time you see a stock move from $100 to $100.10 to $99.90, remember, the number isn't moving by itself. Behind every movement is a market full of buyers and sellers, all trying to answer the same impossible question. What will this company be worth tomorrow?